Talk more about the markets now with Sam Stovall, Chief Investment Strategist at CFRA Research. It's Father Sunday, I think, Sam, because we had Setmeyer on, Rich's son, and now we got you on. And everybody remembers your dad, the great Bob Stovall. So I don't know whether anyone planned it. I think it's serendipity or serendipitous that it happened. But welcome. It's good to see you.
Well, good. Thanks, Joe. Nice to see you, too.
And I said to Setmeyer, his dad taught him everything he knew, but only a little bit of what his dad knew. I think your dad taught you everything he knew, right?
Yeah, and I'm still trying to catch up to his vast amount of knowledge.
So give us some of it. We heard technically that this looks like a normal seasonal correction and not much more, with maybe a low of around 4,200 on the S&P. And I don't care if you want to do bottoms up and talk about what stocks you like or what sectors you like instead of an overall macro view, but where are we?
Well, I agree with you, and I actually believe that while fundamentals will tell you what, technicals tell you when and how far, and the old adage is that prices lead fundamentals. So, yes, there's an awful lot of concern out there from higher oil prices, interest rates, the dollar, et cetera, and that's putting pressure on the markets, which will probably last until the early part of October. But if you look also at technicals, by coming down to the 4,200 level, that is a Fibonacci retracement level. It then becomes the support of the March 23 low and also is close to the 200-day moving average. Even people are talking about the violation of a head and shoulders pattern, which would also bring it down to maybe about the 4,100 level. But I remind investors that more than twice the number of pullbacks, corrections, and bear markets ended in October. Not surprisingly, October has had 35% more volatility than the average for the other 11 months of the year. But I think that because we are heading into the favorable fourth quarter, especially of a pre-election year, that you're probably better off rotating than you are retreating.
Do you think, Sam, in your view, that we see new highs next year in the averages?
Yes, I do. We're in the less than the first year of a new bull market, and we have not had a bull market die before its first birthday. And you have to go back to 1948 to find one that did not eclipse its second birthday. So I would feel fairly optimistic. Obviously, it's not a guarantee that this bull market will continue into 2024. And I think the factors that will come into play are that we don't believe that we're headed for a recession. We do think that earnings are on the ascent, likely to be gaining 8.5% in the fourth quarter of this year, 12% next year. And I think that a lot of the headline concerns that we're experiencing right now will be dissipating. And let's face it, with all of these concerns, why is the market only down 5.5%?
And we don't need a recession to win the inflation battle. We'll be okay. We won't need to keep going higher and higher and higher with the Fed.
I think that the Fed will be raising rates one more time, probably in November. I think what's being built into the markets right now is that the Fed may need to raise rates 2 more times. I mean, who really knows for sure? I actually think the government shutdown might be good for the markets because we won't have a lot of data to fret over on a daily basis, that by the time the government does reopen, CFRA's Washington Analysis Group thinks that this could rival the 35-day shutdown that we saw back in 2018, 2019. But that kind of a shutdown could actually allow the data to show that the economy is slowing by the time we get the fresh data once again.